starting in on chapter 4 now. Okay, with this chapter, we're going to be looking at temporary accounts and permanent accounts, because in the next video we're going to be closing the temporary accounts out, not our permanent accounts. They're permanent because they carry forward. Okay, now let's take a look first at the temporary accounts. There's certain accounts that are temporary. That doesn't mean we get rid of the account, it just means the balance is temporary. At the end of the year, we've got to eliminate or zero out that account balance to start the new year over. Okay, now those accounts are revenue accounts are temporary, expense accounts are temporary, and the withdrawal account is temporary. There's also one more. I'm going to write it up here. You're not familiar with this account yet. It's called the income summary account. And in the next video, you'll see how we use that. So I'm going to write it there, but you don't need to understand exactly what this is yet. The next video, you'll understand, okay? So revenue. If we have $30,000 in revenue this year, then next year we want to start over at zero and start accumulating our revenue for the next year. See, every single year we want to know, well, how much revenue do we have for that year? How much revenue do we have for the next year? So that's why it's a temporary account. It's not that we get rid of it, it's just that we start the year over at zero and then we track the new balance for that year, okay? Same thing with expenses. We want to know, well, how much was our rent expense this year? How much was our utilities expense? How much was our wage expense for this year? That's great information. But then for the next year, we want to start all over at zero and monitor the wage and rent and utilities expense for the next year. So that's why these are temporary accounts. And same thing with the withdrawal account. How much did our owner withdraw from the company this year? And how much next year? And how much the following year? Okay? So these are the temporary accounts. The permanent accounts are our asset accounts, our liability accounts, and then our capital account, which is our owner's equity capital account. Those are permanent accounts. These balances we don't zero out at the end of the year, okay? You don't zero it out. If you have $100,000 in your checking account at December 31st, okay, at the close of business on December 31st, if you have $100,000, then on January 1st when you open up, you're not going to zero that account out. You're going to start out with $100,000 the next year. That's how all assets are going to work, okay? You're going to carry the balance from December 31st over into January 1st. Whereas these accounts, revenues, expenses, withdrawals, the December 31st balance will then be zeroed out at the end of the day, and January 1st you should start with brand new balances to track the new year transactions, okay? So here are our temporary accounts, and here are our permanent accounts. And now we're going to learn in the next video why we need to close these out and the process on closing those out. Thank you.